The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity.